Zacks Rank Buys, stocks with a short-term buy or strong buy recommendation. Now, here are more Zacks Rank Buys. We are going to check out a couple of growth and income stock picks in this Zacks Rank Buy segment with Todd Bunton, our growth and income stock strategist here at Zacks.com. And one of the ones that you have written about recently, on August the 1st, as a matter of fact, is TAL International Group. TAL, the ticker symbol. This company leases intermodal freight containers.
That's right, yeah.
Whatever that means.
Yeah, any kind of shipping containers, TAL will lease it. So they're very heavily tied to the global trade.
So just shipping containers
exactly.
in general.
Yes,
okay.
Yeah, but very much tied to global trade, global economic activity. So investors have been a little squeamish here lately with possible slowdown here in the U.S., but I think with TAL's dividend and their valuation, I think it provides a lot of potential upside if it is just, in fact, maybe a small slowdown instead of a recession coming. Reason for that is the company blew it out of the water in the second quarter of 2011. Earnings per share more than doubled year over year. Revenue came in 38% above last year, and earnings per share was well above the Zacks consensus estimate. And management actually was pretty bullish. They give a very bullish outlook for the rest of the year, saying they're still seeing a lot of activity, a lot of orders come in, so that offers a lot of potential upside. And also, analysts have been consistently raising their estimates. The company's delivered 6 consecutive positive earnings surprises. Wow. So every time the company beats, analysts will raise their estimates. The company beats, analysts raise their estimates, and that was definitely on play in the second quarter. So consensus estimates have just continued to increase, as you can see here in the price and consensus chart. And analysts are projecting pretty strong growth, about 70% earnings per share growth in 2011. They're forecasting only about 4% growth next year, so they do kind of have maybe a slowdown priced in a little bit. But the company's also going to be supported. The stock's going to be supported by their 6.8% dividend yield, a very solid yield. The company's raised that 7 consecutive quarters. Now, they did slash that back during the Great Recession because obviously they're tied to the global economic trade market, so obviously economic activity was super low, so they had to cut their dividend because business was hurting. But they've raised that 7 times since then, 6.8% dividend yield. That should provide solid income. They have solid growth, and you wouldn't pay much for it. They're trading about 8 times forward earnings. The industry average is around 18 times. So again, it seems like the market has definitely priced in some slowdown here. So if we don't get that, there could be a lot of potential upside, and their PEG ratios are right around 0.7.
Okay. And then Philip Morris, PM, the ticker symbol, that global tobacco giant.
That's right. Is
another one here. Where's the growth in income here?
Well, it's Philip Morris International. So they split from Philip Morris USA back in 2004 when they were part of Altria Group, and Altria spun them off in 2008 as just an international tobacco maker. They still have the famous Marlboro brand that they sell all across the globe, but they're not tied to the U.S. regulation concerns that they're really coming down on tobacco companies and the excise taxes. So
because they're international,
right? So yeah, you're getting a lot of growth in the emerging markets where regulation isn't as big of a concern, at least right now. So the company's been it's a very defensive name. If investors are worried about a slowdown, this is the type of stock that you'd want to move into because they obviously are more defensive name because people are going to buy cigarettes. It's a very inelastic demand type product. So the company also delivered a very solid second quarter. Earnings per share came in 11 cents above the Zacks consensus estimate. Revenue was up 10% year over year, and that was driven by strong growth in Asia, particularly Indonesia and Japan and Korea. So that's driving the top line. And management actually raised guidance going forward for the remainder of the year. That prompted analysts to revise their estimates higher. And you can see in the price and consensus chart, estimates have been consistently climbing over the last several months. The company's delivered 3 consecutive positive earnings surprises. And analysts are forecasting 23% earnings per share growth this year and 10% growth next year. So you're getting solid double-digit earnings per share growth, and you're getting solid income too. They pay a dividend that yields about 3.6%. The company's a cash machine. They generate tons and tons of free cash flow, so they've been raising their dividend. They've been buying back a lot of shares too. Like I said, they were spun off from Altria back in 2008. Since then, they've spent $19 billion buying back shares. So,
I can remember when it was a big deal when Altria took them over.
Yeah, it was. They used to be owned by Kraft too, and they split that off. Yeah, but the company is just a huge cash flow maker. The cigarette business, whether you like it or not, it produces a lot of cash, and they've been returning that to shareholders. And the valuation picture looks very reasonable. They trade about 14 times forward earnings. That's in line with its historical average.
Do you own either of these two?
I do not.
All right. Well, check out some other stock pick ideas for yourself at our homepage, Zacks.com, if you haven't already. And if you have, check back often, because we put 4 new ones up there for you daily, one in each of the investing categories that is written about on Zacks.com. With Todd Bunton, I'm Terry Ruffalo.